before taking exceptional provisions into consideration, the company looking pretty stable with both net interest income and operating income coming in pretty steady. Run us through the year that was for Diamond Bank.
Thank you, Alicia. 2009 was certainly a challenging year for Diamond Bank and the industry in total. We experienced some asset deterioration during the year as a result of some customers having challenges. But so towards the end of the year, we had to take some more losses, and this was the result of the weakness in the market. But that is now behind us. We have a strong balance sheet. Liquidity is strong. Capital adequacy is very strong at 19%. And so I think that we have now laid the foundations for a strong 2010.
Well, of course, let's focus on the positives before we get to the negative. I mean, you've managed to achieve continued deposit growth. We've had customer deposits up 33% and total assets up 9%. How have you been driving that agenda, first of all?
Well, we've embarked on a retail strategy, which has begun. This was done about 18 months ago, which is now beginning to reap some dividends. We are very strong on the liability side, and we also embarked on a Project Sparkle, which was a project to improve our organizational productivity, and we have seen an increase in sales optimization, and we believe that this will continue strong in 2010.
Well, despite this, we had gross earnings coming in lower than that of last year's, and one would assume that it's on account of an extreme reduction in loan extension during the last quarter. It could be responsible for that near flat increase in gross earnings, where most banks have been pretty risk averse as a result of the CBN's audit. Run us through your drive on that front in terms of extension of loans.
Well, certainly towards the last quarter of the year, we saw some tightness in credit in the market, and this was as a result of uncertainty in the market. And so most banks were not availing credit to their customers, and some of them buckled under this pressure. We now see some return to normalcy. The central bank is also trying to stimulate growth in credit in the financial sector by offering some stimulus to banks and to customers in the form of long-term and cheaper funding. And so we are confident that the credit market will begin to loosen as we go through 2010.
Of course, the risk aversion that we have seen come to the fore hasn't been entirely unwarranted here. There's no hiding away from the exceptional provisions. Diamond Bank has had to make provision for losses of 24.7 billion naira compared to just 1 billion naira in December 2008. That's a pretty sharp rise that we've seen there. What's contributed to that extreme increase?
Like I said, we had some exposures in some segments that deteriorated due to economic downturn. We have taken provisions on those assets, so we do not foresee any more unexpected losses going forward. We also have put in a robust risk management framework that looks at credit and also our operational market risk. And this we have also put in a strong, robust early warning signal mechanism, so that would help us foresee any problems and deal with it as it arises.
There is still a lot of tentativeness out there in the market because after Q1 results last year, the bank said that it had made a full provision for the 2009 fiscal year. Now, are we looking at a bank with a clean bill of health, and how can you be certain?
Well, thank you. Our Q1 results should be out later today, and you will see that our the provisions we're taking do not compare to last year. They're much lower. Our operating profit is strong, and we've also our PBT will be positive as well. And we have a risk management framework that ensures that we take the appropriate capital allocation as they arise, and we don't see any unexpected losses going forward. And so we are very confident that we are on a robust footing for the quarters ahead.
Well, you say that you're out with the Q1 results of this year, this afternoon. We've got the NPL ratio at the moment sitting at 18.2%. What is your outlook in that regard, and what level are you targeting by year end?
Well, certainly the NPLs have improved, where they're now down to about 17%. We have coverage ratios which are going up, and with expected recoveries of about 30% of NPLs, they should come down considerably to below double-digit figures.
To what extent, just taking a look at, moving forward and growth prospects, you mentioned that you do have a very healthy balance sheet. You're sitting with strong liquidity and capital adequacy ratios of 37.6 and 19.5% respectively. With that in mind, to what extent are there any plans for fresh cash injection, whether it be debt or equity, to fund growth moving forward?
Well, currently we're very comfortable with our capital adequacy ratios, and we believe we have the resources to continue our business as usual. Our focus is on organic growth, and we believe that we are comfortable with the capital that we have. But should there be any need to raise capital during the year, we have shareholders who will back our capital requirements. So we're very comfortable in terms of capital requirements.